You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Welcome back, everybody. Welcome back, Hamish Hodder. How are you going? There's some alliteration. Hamish Hodder, how are you going?
Yeah, I'm doing well.
Cracking?
I just same old. Still in lockdown again. I think I thought lockdown was kind of easing out last time we spoke last week, but no, that's not happening. So
you guys still recording cases each day, or what's going on?
Yeah, we are. Yeah, they're kind of just staying at the same level, which is a lot lower than a lot of other places around the world, I'm sure. But yeah, it's high enough that we're in a full lockdown currently. So it is what it is. But how are things in Canberra?
Sunny Canberra, things are going well.
Sunny Canberra, really?
Yeah. I always say that because it's usually just like freezing cold and not that great. So I sarcastically always just call it sunny Canberra. No, it was quite cold this morning. It was like -5 this morning. But no, it actually is sunny and it's going well. And somehow I don't think we have any COVID here, which is surprising considering Sydney is like the COVID capital right now. But yeah, we're very lucky in Canberra. We have somehow fluked it and have pretty much remained COVID free. So
amazing.
The only annoying thing is now, even though there's no COVID here, we can't go anywhere because everywhere else has got COVID. But
that is true.
That's just how it goes, isn't it?
Yeah, it is. To our delight, we found out this morning that almost all of our cases from yesterday, but almost all of the cases recently can be sourced back to these 3 delivery men who came from New South Wales, I think. And they have like video footage of them not wearing masks and like talking with people and I mean, it is what it is, but
gosh darn it. Damn it.
They're in a bit of trouble at the moment. I think they're probably at the top of the most hated people at the moment in Victoria.
Yeah, you'd imagine so, wouldn't you? Yeah. Anyway, good old. To be honest, I just want to get this vaccine already. I think we're actually, I don't know what the age categories are, but there are some people in their early 30s which are now getting their hands on vaccines. So I feel like maybe it might not be too far away where people in their 20s might be able to get vaccines as well, which would be really exciting. I'd definitely be jumping on board.
Yeah, I mean, hopefully I think they just got a new shipment of the Pfizer vaccine in, which is the recommended one for anyone under, I don't know what age it is, but for young people in general. Yeah. So, hopefully we can get that out as quickly as possible. So far behind many other major first world countries. So a little bit disappointing that it's taken so long, but hopefully we get there in the end. We'll get there.
I think people, honestly, I don't want to drag on COVID for too long, but I think people are just over it now. I think everybody, there's Sydney's been in lockdowns and Melbourne's had the worst of it. How many times have you guys been in lockdown? It seems like you guys are in a lot of lockdown. I mean, surely you must be feeling this as well a lot with your friends. People are just like, their patience is wearing thin now.
Oh, yeah.
I mean, it's just ridiculous. Like, obviously, it's the right thing to do and we have to go into these lockdowns, but, you know, there's only so many times you can lock people down and say, no, you can't go out, you can't see your friends, and people just get fed up. I mean, we're still all going to do the right thing and we're going to, you know, follow the rules and all that, but it's just a pain in the butt.
Yeah, I mean, it's especially been frustrating this year because it's been so volatile. It's been like, at least last year, I mean, I think we did over 100 days in lockdown last year or something, but at least it was just a lockdown and we knew what to expect week after week. Whereas this year, you know, we've gone into 5 lockdowns now at various times and we're just fluctuating from being able to go fully out to bars and watch the footy and to being completely isolated within 24 hours notice. It's yeah, it's been I'm very much over it. Of course, still following all of the rules, but as soon as this vaccine is available, I'm going to get it. And I'm going to encourage everyone to get it.
I'll take 10.
Because I just want to just stop these lockdowns.
Yeah, no, fair enough. Oh dear. All right. Well, I think that's enough about COVID. COVID can go away. But we do have some interesting stuff to talk about today. Of course, you probably would have seen this in the news. Jeff Bezos. We're talking about Richard Branson. Now Jeff Bezos has gone into space. We'll talk about that. Netflix earnings. So earnings season is just starting to ramp up now. We've got Netflix, Chipotle, Coca-Cola to talk about. And there's a little bit more news on stimulus payments for Americans. This is kind of like the week before things get serious. Like there's a couple of companies that their earnings have trickled in, but I think over the next 2 weeks, then, we're going to go from this period of having kind of light news weeks where there's not much to talk about, and everything's just going to get dumped on us over the next couple of weeks. So I imagine this episode will be pretty light on, and then the next 2 weeks are going to be very heavy.
yeah, exactly right. We do have a huge update out of the Chipotle. I don't know, in terms of Chipotle. I don't know where I was going with that. We have a huge update on Chipotle's, which you want to stick around for. We're going to save it till late because we know that's what everyone's waiting for. So
absolutely. All right, let's get stuck into it.
Today's episode is sponsored by Sharesight, which is an application you can use to track the performance of your stock portfolio. So basically, you can pull in all of your trades either manually or automatically if you use one of the associated brokers, which is pretty much all of the major brokers, especially a lot internationally outside of Australia. And it will give you an accurate picture, an accurate tracking of the performance of your portfolio in terms of capital gains, dividends. If you have dividend reinvestment plans, it will do all of those calculations for you. Currency gains if you're buying shares internationally or you hold foreign currencies. And then you can also use it for when it comes to tax time. So Sharesight generates up to 10 different reports that can be used at tax time to work out things such as your capital gains, your dividend income, and more. And at the moment, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors. And you can also use that link to get 4 months off a yearly subscription if you sign up to a paid subscription for more features. So go check that out for everyone who is listening, but in particular people who are in Australia and New Zealand as we are at tax time. So there is still time to get your investing tax affairs in order and save yourself some money and maybe even time. Time and maybe money at tax time.
Yeah. Have you done your tax return yet?
No.
I did mine yesterday. Oh my gosh, it's getting complicated now, but that's a story for another day. But yeah, it is tax time, and Sharesight is certainly helpful. That is the one thing that I did not have to worry about doing my tax return this time is what the hell I did with my stock portfolio, my buys and my sells, because luckily Sharesight has all that information pre-prepared, ready to go. So that made things a little bit easier. But tax time does start to get complicated when you own a business, doesn't it?
Oh yeah, it's horrible. Yeah, I'm going to be delaying that as long as possible.
The only reason I wanted to pounce on it early is because I needed to go get a loan from the bank, so I want to try and get this house sorted out. But anyway, that story for a different day. No one cares about that. Let's talk about Jeff Bezos. Hey.
Ah yes.
Did you watch it? I sent you that link. I saw you saw it. Did you watch it or nah?
Yeah, I did. I watched. I had to watch the launch because I was so worried that something bad was going to happen. So I just watched until I watched probably maybe 10 or 15 minutes of it.
Yeah, me too. Yeah, it was so strange. I felt the same. I felt more worried about this launch than the Virgin Galactic launch. I think probably the reason for that is because Jeff Bezos was launching, in a rocket from the ground. Whereas, when we cut to Richard Branson, he was already flying up in the plane, up in, the upper atmosphere. And then all we had to watch really was the rocket detach and just take him that last little bit. But yeah, we both stayed up for the live stream. That was 11 p.m. Tuesday night. Tuesday night.
I think so.
So for those that don't know, Jeff Bezos, former CEO of Amazon, he launched aboard the rocket New Shepard. And as I was saying, different to Branson, Jeff Bezos pretty much he and his other 3 passengers, they sat in the rocket on the ground on the launch pad, and then essentially got launched up into space, which was pretty cool to watch, actually. So yeah, I did say he launched with 3 others. So his brother Mark, I think Mark Bezos, an 18-year-old from the Netherlands called Oliver Damon, and Wally Funk, an 82-year-old American aviator. So that had a cool crew. The flight itself was pretty uneventful, which, of course, when you're talking about rockets, is a very good thing. Yeah. Essentially fueled up, rocketed up. They floated around in the capsule for a few minutes. They were allowed to, of course, unstrap and experience their weightlessness. And they had a couple of they had like ping pong balls in their pockets, and they were like throwing them around the cabin. And Oliver Damon threw a Skittle at Jeff Bezos, who caught it in his mouth. That sort of thing. Like, imagine telling that to your friends. It's like, what'd you do last week? Oh, I went on that rocket, that Blue Origin rocket with Jeff Bezos, and we went up to space, and I threw Skittles in his mouth. Oh dear, oh dear.
It's crazy. It always just surprises me when those rockets launch off. It just looks so dangerous. I just get so nervous. It looks horrible. And I think I've watched so many of SpaceX's launches where nothing, terrible. I mean, there's no one in them, so nothing terrible goes wrong, but like an engine just kind of explodes or something. And I think that just keeps in my mind how dangerous it really is when they do this sort of thing. I don't know. I don't like it.
Yeah, it is pretty nerve-wracking when you have that much fuel. Combustible fuel and all those engines, but no, this one went perfectly to plan. They went up, floated around for a few minutes. The capsule separated from the first stage. The capsule parachuted back down to Earth. The first stage flew back and landed on the pad, which is pretty cool. And of course, the reason that we're really talking about this on the Young Investors podcast is because, obviously Blue Origin's company, SpaceX company, Virgin Galactic's company, and we're kind of looking at how this worked out. Well, last time we were talking about Virgin Galactic and talking about how it worked out for them in terms of advertising and investor confidence in the company and that sort of thing. So I wanted to look at that stuff again. So again, this Blue Origin flight was live streamed on YouTube, and so far, a day and a half after the live stream, the live stream has 3.4 million views up to now. Again, the news was plastered all front page of every news site. I actually thought, interestingly, I thought that the Jeff Bezos launch was going to get way more coverage than the Richard Branson one. I feel like, I don't know why, but I feel like Jeff Bezos is just in the news all the time. Whereas Richard Branson, I feel like he's like, I don't know, he's just kind of that cool customer that doesn't really draw too much attention to himself.
Yeah, he flies a little bit more under the radar. Bezos, particularly over the last 12 months, has been kind of the poster of like evil billionaire. So he's kind of been an easy target, I think, to put his name in the headline of certain stories or any stories really with him associated with it. And I mean, he just had his massive divorce and he left Amazon. So, I mean, I guess there's just a lot of things that have been going on with Bezos recently. But yeah, I would have thought the same thing, that I would have thought Bezos would have gotten more coverage.
Yeah, and that's what I want to say is that the Virgin Galactic launch, the live stream, had about 6 million views by about the same time, whereas the Blue Origin launch had 3.4 million views. So I was actually very surprised by that. I really thought that the Blue Origin launch was going to gather way more attention. So I wanted to kind of put it out there and ask you, do you think there might have actually been a first mover advantage for Branson to get ahead and be the first one to go up? Do you feel like some people watched the Virgin Galactic launch, went, oh yeah, that's cool, and decided maybe not to bother tuning into the Blue Origin launch?
Yeah, I think that's fairly likely. I mean, that makes a lot of sense, right? I think a lot of people would have been interested in seeing a rocket launch, but not so interested that you watch one and you're like, oh, I have to tune in for the next one. I'm sure a lot of people are in that camp, but I guess the views don't lie. A lot of people didn't want to tune in to the second one. First one was enough for them. So yeah,
very, very interesting. Yeah, I think the same. Pretty staggering, and also very smart by Richard Branson. I mean, this is what the media was talking about in the lead up to these launches. They were talking about the billionaire space race is what it was called. Like there actually is a reason to be the first billionaire in space. And looking at the kind of marketing, advertising, media side of it, yeah, it does seem like there was an advantage in being the first person up there. Richard Branson certainly got more coverage than Jeff Bezos, but yeah, I mean that is just looking at the straight up full live stream on YouTube. I mean, of course, there's going to be millions and millions of other viewers of that footage through various other YouTube channels and news sites and whatnot. So maybe it's not the perfect metric, but I still think it's quite interesting. But anyway, that's pretty much all I wanted to talk about with Jeff Bezos going to space. It still was pretty cool. And if you're interested in space or space flight, I would definitely recommend you look up on YouTube Blue Origin launch. But chances are, if you're interested, you've probably already seen it. But yeah, that's what I had to talk about. So should we wrap up that story and get into some more investing specific content and talk about some company earnings?
Yeah, absolutely. We can just start with Netflix, which reported their second quarter earnings for this year, and it was a little bit of a mixed result, I think, at least from what I can see. Revenue came in at $7.3 billion, which was up 19% year over year. So, they're still seeing massive amounts of growth comparatively to last year, which, remember, last year for Netflix was extremely good because a lot of their subscribers, at least this is what management said, a lot of their new subscribers got brought forward into 2020 as people were in lockdown, spending more time at home. So to have 19% growth year over year is still very, very impressive. And then in terms of what was driving that growth, so of course that revenue is influenced by adding more members around the world, and then also changes in the price members are paying, the average revenue per member. So in terms of the number of ads, they added 1.54 million members in the quarter, which represented an 8.4% year over year increase. But it was actually I think it was the smallest amount of subscribers they've added in a really long time. Just looking at their quarterly ads for like the past 5 quarters. I mean, in the second quarter of last year, they added 10 million subscribers, and that was one of their really big quarters where they benefited from the pandemic, really. After that, they did 2.2 and then 8.5 and then 4 million. And then this quarter, 1.5 million. So
really fallen away.
Quite a substantial drop off. Yeah, exactly right. It brings their total to 209.2 million subscribers. And I think we speak about, I say this every time I look at Netflix's earnings, but you've got to wonder what's the upper limit to that. Like where does that finish up?
I'm not sure what they would perceive the total addressable market to be. How many members? But I guess they just got to keep. I mean, what the story is with all these kind of subscription places, they start in North America, and then they chase international subscribe, and then they just try and funnel their once they feel like their growth is slowing down in international markets, then they try and find newer international markets or places that haven't gone yet. So feel like there's always growth, but I'm just not sure. It's interesting to think about where the growth comes in terms of geography, because I think that North America, they don't seem like they're growing very much in North America.
Yeah, they're not actually. So, so this quarter specifically in the North American, or it must be the North American segment. So, the US and Canada, they saw a slight decline in the number of members in the number of members in that area, but they also noted that in the second quarter of the year, that's actually what they typically see because of the timeline and the calendar of when they're releasing content, and that they actually saw the same effect last year, but since then they've added, I think, about 8 million in the US. So it's kind of one of those cases where if you just look at the quarterly data, it kind of looks bad, but if you look at it over a 12-month period, including all of the seasons, in relation to them releasing content, particularly for people in the US, then it looks a little bit better. But still, 8 million is kind of a relatively small amount. But overall, 2021 is looking like it's going to be a really bad year for adding members than any of the past 4 years. However, management kind of is looking at this in terms of lumping 2021 in with 2020 and saying, well, if we add 2020 plus 2021 and take an average and kind of assume that a lot of 2021 subscribers were brought forward into 2020, then you can make the argument that on average over the past 2 years, their subscriber adds have been fairly normal. Still lower than previous years, but a lot better than what 2021 on its own is going to look like. So I guess we'll just have to see what happens with that, whether it recovers. No one really knows ever what kind of trend is taking place until it kind of plays out. But you would expect that moving into 2022 that they would continue to see increases, particularly around the world. In terms of their average revenue per membership, it actually rose 8% during the period, which is a huge increase in the price they're charging. 4% of that was from foreign exchange, so you could kind of chalk that up to being out of their control. And then 4% was them actively raising prices. So they were able to get some growth from new member ads as well as increasing the average revenue per membership. They've also improved their operating margin on a consistent basis. So
that's good.
Annual operating margin is expected to hit 20% now in 2021, and that's all the way from 4.3% in 2016. So in terms of revenue in relation to their expenses, that gap is starting to widen substantially. So they're certainly
and I'm not sure if you know this, or maybe we'd have to do more digging. Is that related to them not having as many expenses, or have they said that they're kind of winding back up to almost full operations again?
Yeah, I mean, they're winding back up to full operations. I mean, that increase is really being driven by the fact that they've spent a significant amount of money over the past 5 years investing in content, and it's only as they add additional subscribers that margins have been kind of expanding. So we should continue to see margins expand unless they decide to ramp up their spending on content. And this is really the problem that we've kind of spoken about with Netflix is at what point can you slow down your spending on content? You always kind of need to be full on the throttle spending on content to outpace competitors. But it is impressive that they've been able to improve their operating margin over time, even while they've continued to increase their spending. Operating income, as a result, came in at $1.8 billion, which was up 36% year over year. In their report, they also, as usual, mentioned the performance of some of their content as well as what content they're bringing out in the future. And I didn't really want to speak on anything. Nothing really stood out to me in particular this quarter of content that performed extremely well. The main thing I think I want to talk about is cash flow and debt, which we always have fun talking about with Netflix. Free cash flow came in at negative 174 million compared to 900 million in the same quarter last year. And that was primarily driven by increased spending on content. So, of course, last year they were not spending as much money on content. They spent about $2.5 billion because they were in lockdown and they couldn't do as much production as they wanted to. This quarter, they did $4.1 billion, and as a result, they're back into negative cash flow.
And to be honest, that's what we were saying last year. at the height of the lockdown in the US, and Netflix was coming out and posting these amazing, like these huge free cash flow numbers. And, everybody was talking them up and saying, oh, look at how good Netflix is now. And we were kind of sitting there saying, hang on. So you're telling me just for Netflix to be in the black in terms of cash flow, they have to have, they literally have to have a global pandemic that is forcing people to stay in their lounge rooms. So they're essentially going, oh, I may as well buy Netflix because I got nothing else to do. And also there needs to be some sort of lockdown that stops them from making content, literally stop. They're trying to make content, aka spending money, but something literally gets in the way of them doing that. Say, no, actually, you can't spend that money. You need to be locked down. I mean, they were the conditions. It's like, man, I remember us saying this back last year. We're like, are these the conditions that are needed for Netflix to make money? I mean, if that's necessary, like obviously the pandemic's going to go away. We've got a vaccine now. It won't be too long. It's like, that is crazy. If that's what's needed for Netflix to produce positive cash flow.
Yeah.
And it's ridiculous. As the situation's recovered, lockdowns aren't as severe. They're now able to get back to making more content. What do you know? Straight back into the negatives for free cash flow. I find that a little bit funny, to be honest.
Yeah, and I mean, with the amount of competition as well that's coming, they just need to keep pushing on content because I don't know about you.
Yeah, they can't stop.
Yeah, I don't know about you, but I am constantly switching out between Netflix and Stan and Disney Plus, depending on what I want to watch that month. Like if I just want to binge watch a series 1 month, I will cancel the other ones and just buy one. And that's pretty much what I've been doing. It's very rare that I am sitting there and I have multiple subscriptions and I'm kind of browsing around. I'll usually actively figure out what I want to watch and cancel them. And I think that's going to be a struggle for these businesses going forward. I mean, they just have to push as much money into content. And that's not necessarily a bad thing. I mean, I think if they're break even on cash flow and they're constantly increasing the amount of content they can produce, I think that is a good thing over the very long term for the business. But I mean, cash flow is just one concern that they have. They also have this growing pile of debt that they may need to consider how they're going to pay that down in the future. During the quarter, they didn't actually issue any debt, so they didn't grow their debt. They kind of just let some of their cash burn down to pay for that, the fact that they had negative free cash flow. But long-term debt still sits at just under $15 billion. Short-term debt, so debt that's going to become due in the next 12 months, is at $700 million. Although they do have $7 billion in cash. So they do have a lot of debt. Net debt sitting at about $8 billion. So a little bit better. But I mean, they've still got a huge amount of debt that they intend on keeping. So they're just going to keep rolling that debt over for as long as possible. And if they're able to do that, then that's fine. But let's pray that they don't get into a situation where they can't roll that debt over for some reason, or that they have to roll it over for a significantly higher interest rate. If they have to do that, they might be in a bit of trouble. But
and that's what we said. Like, exactly what you said. It's not a deal breaker. It's not like, Netflix is going to go bankrupt or anything like that. It's just a risk. And we look at all these companies in that kind of way. Like, okay, where are the big? Are there any red flags? Are there any big risks with this company? And I mean, you could probably say, chances are Netflix is going to be totally fine, and they're going to get to a period of positive cash flow on a sustained basis and they'll pay down that debt and it's all going to be fine. And, you could say that's probably going to happen. But for us as investors, we're always thinking that rule number one from Warren Buffett is don't lose money. So we're always looking at these situations where we could potentially put our money. And we always think, okay, what are the risks where I might lose money on this investment? And we want to find ones which have very few of those situations. Like there's always going to be some risks. But like, for instance, I look at Netflix and I go, okay, one of the big risks that flashes up in my head straight away is, okay, they don't really produce positive free cash flow on a sustained basis. And they continually, up until now. They've continually been adding more and more and more long-term debt. And while we say, maybe that's going to be completely fine if they can keep rolling it over, that there's a risk there. There's a risk that, okay, what if something happened and that they needed to pay a much higher interest rate on that debt or something like that, and they can't get that free cash flow to be positive? How they going to pay it down? Do they have to screw over shareholders to be able to keep going? That sort of stuff. So that's kind of, I guess, the main thing that pops up in my head with Netflix. Like, I love the company. I think they do a great thing. I love their product. I watch Netflix, but I think sometimes you have to separate, and I think, for example, Tesla shareholders quite commonly can't do this. You have to separate the products and the what they're doing for the world for actually how the business looks. And that's why I get a bit of a question mark over Netflix. Does that make sense?
Yeah, absolutely. And I mean, competition isn't going to go down anytime soon in this industry. They shared an interesting pie chart that was of how TV time is spent in the US. So basically TV engagement, how people are engaging with shows. And according to their data, which was from Nielsen, I think was the research firm, they showed that 27% of TV time in the US is spent on streaming services, with 63% still being spent on broadcast and cable TV. So that was kind of Netflix saying that they will still be able to see a substantial increase over time in how much people are engaging with streaming services as they kind of move away from broadcast and cable television. But of course, as more people engage with, the way I thought about this was, the more people that are engaging with Netflix, say spending more time watching Netflix, the more content that Netflix has to have in order to satisfy you for that longer period. So
yeah, absolutely.
It's going to be I think it's a tough business, but I really do like what Netflix produces. I think they do a very good job at producing high quality content, and I hope they continue to do it in the future. And ultimately, I mean, if you're not investing in these businesses, then competition is good if you're a consumer. So
yeah, exactly.
I want to see Disney Plus I want to see new streaming services and big multi-billion-dollar companies put billions of dollars into making new content, because that means we have more to watch. So
it's better for us.
Yeah, I'm not against that at all.
Yeah, exactly. Is that all we've got to talk about for Netflix?
Yeah, pretty much. Oh, one other thing I did miss. I don't have too much to say on this, but they're also entering the gaming industry. So they also announced that they're going to be doing more interactive content. So they've done a few interactive kind of choose your own adventure TV shows where you basically get options on the screen to make the characters do something like a normal choose your own adventure. And they're also working on mobile games as well. So that's what Netflix is doing at the moment. Who knows if they have the money to move into that industry at the moment, but they're doing that. They also did a $500 million share buyback. Again, I don't know where they're getting this money from.
Yeah.
But yeah, they love spending it. That's for sure.
Yeah, I reckon. How about you focus on making it first? Anyway, well, there you go. That's very interesting. I don't think I would have done that buyback, but interesting that they're trying to get into a little bit of the more gaming interactive content. It might be a stroke of genius. What if it takes off and that's something that the other streaming services don't really provide? Then it could be another kind of first mover advantage that they've got. But
dangerous words we'll see what happens when you're investing. What if?
What if? Yeah, of course. Yeah. You certainly wouldn't want to bank on this new mobile gaming platform that Netflix. That's my whole investing thesis. Anyway, all right, let's move on. I want to talk about Coca-Cola for a bit. You want to talk about Coke?
Yeah, what's happening there?
I love Coke. Do you drink Coke?
Yeah, occasionally.
I shouldn't. You really shouldn't. But you got to love Coke. It's pretty damn tasty. I didn't know Coca-Cola is one of those companies that just owns the world pretty much. Owns Coca-Cola, Sprite, Fanta, Schweppes, Powerade, Vitamin Water, Smart Water, Foos Tea, and a number of other juice, coffee, and milk brands. She's a big company, Coke, KO. So let's start with, we'll start with revenue. That's a pretty logical place to start. So for Coca-Cola Q2 earnings, revenue was up 41% quarter over quarter to $10.1 billion. So face value, that seems pretty darn impressive, right? Quarter over quarter growth of 41%.
Jeez.
However, Q2 last year was their worst quarter in a very long time with the lockdown, with the pandemic. So I think instead of if we just focus on quarter over quarter, it's just going to make Coke look like the best company you've ever seen. So I think what would be a better thing to do is focus on this Q2 versus the previous Q2 that wasn't pandemic affected, which was Q2 2019. And if you start doing that, really the story of Coca-Cola is, for this quarter anyway, is that Coke is back to their pre-pandemic levels, which is, good to see. Good to see for Coke shareholders. So this quarter, their revenue was $10.1 billion. In Q2 2019, the revenue was $10 billion.
Right.
So, and it's very interesting because if you look at their Q2 2021, it looks practically the exact same as Q2 2019 in many, many metrics. So like gross profit, operating income, net income. Like net income Q2 2019 was $2.61 billion, and in Q2 2021, $2.64 billion.
Wow.
So yeah. You look at some of these, I was scrolling through hypercharts and just comparing the two quarters, and they literally look the same, which is just bonkers. And, you could say, this could be a fluke, but, when you consider other factors like their gross margin always stays at 60%, their operating margin is always 23% to 30%. To me, what I think when I look at these two comparable quarters is we're just looking at a very mature business.
Yeah.
The business knows what they do. They know their numbers. Their chain is optimized. They've done their big years of growth many, years or decades ago. They know that they can just pump out. They're just a cash flow machine. And now I think they've just accept that, our business is mature and it's probably just going to chug along with the economy over time. Would you agree with that? Is that a logical kind of takeaway from comparing these kind of quarters?
Yeah, definitely. I think particularly if you just focused on, say, the main Coca-Cola brand, you can definitely see that they've very much likely reached quite close to the upper limit of both the revenue they can generate from that segment, excluding kind of, 1% to 2% increases with inflation or whatever, and also the efficiency of their business model. I think they sold, I hope I've got this number right. I'll look it up after I say it just to double check it. But I believe last year they sold, or maybe it was the year before, sold 30 billion cases of Coca-Cola in a single year, which is just an insane amount of drink to sell in a year. I was blown away when I looked at that. I was looking at that because I was looking at Monster Energy, and I kind of wanted to see what the pinnacle of a drink company does in sales throughout a year. And it's 30 billion cases, which is just mind blowing, right? That's like one case for that means on average, every single person in the world drinks like 3 to 4 cases of Coca-Cola a year, which is just, that's a crazy stat.
Oh my God, that is insane. Yeah. It's definitely the biggest drinks company for sure.
Oh yeah, absolutely, by far.
Is there any? Yeah, there wouldn't be any. What would be the second biggest? Pepsi.
I think Pepsi is bigger if you include all of their brands. I think if you just look at the Coca-Cola brand itself, that is the best selling beverage ever. But if you start to, of course, Coca-Cola's done it as well now, and PepsiCo to a bigger extent are expanding now to acquire not only other drink companies, but a lot of food companies. And just kind of becoming a food and beverage conglomerate, because that's really the only way you can grow from there. I mean, once your drink reaches that peak, I'm sure the main Pepsi drink is, similarly as popular, maybe not as popular, but it's up there. I mean, you can't really expand that anymore. Once you have people drinking Coke every single day, you can't really go any further with that drink. You have to sell them something else. You have to sell them a packet of chips or something.
No, I agree. I think you're right. I think they have pretty much figured it out so that from now on, I would, as an investor, if you're an investor in Coke, I wouldn't expect huge growth rates. I would just expect them to kind of grow as the general overall economy does.
Yeah.
Just as a quick side note, I wonder how many cases can be put down to just Warren Buffett. How many cases per year, Warren Buffett and Charlie Munger, how many cases of Coke do they drink?
Well,
it'd be a lot.
Yeah, it would be a lot. I'm doing some quick maths here. Let's say three cans. Let's say 3 cans a day. This would be 45 cases a year. How many years?
What's in a case?
24. It's like 24 okay. I think 8 or 12 ounce. I'm not quite good with American fluid ounces, but I think it's 8 or 12 ounce cans is like the equivalent of a case.
Oh, okay.
So,
right.
Yeah. So that would be 45 cases a year. How many years are we putting this over? Like 50, 60?
Yeah, true. The guy's 90 now. So, yeah,
well, I mean, we could probably go
50 years.
Let's go 50 years. So,
50 years.
Okay, 2,300 cases of Coca-Cola. He's it's a drop in the bucket.
Oh, that is hilarious. That is hilarious. Oh, the man deserves it.
He's doing his best.
Yeah, he's certainly given a lot to Coke over the years, so he can get some back.
Yeah, exactly.
So we'll keep moving on with Coke. Interestingly, this is from CNBC, the CNBC article on the earnings. CFO John Murphy said that the company doubled its marketing dollars during the second quarter compared with a year ago when the beverage giant slashed that budget to preserve cash. I wanted to talk about this or bring this up really quickly because it really does play into what we were talking about, how we were seeing, Google, Facebook, YouTube ads, how they had that dip in Q2 last year of their advertising revenue because Coca-Cola is a massive advertiser. They spend so much money. I mean, think about how, or maybe do this as an exercise over the next week. Just make a mental note of how many times you see the Coca-Cola logo, and I bet you will see it a lot. A lot. Their advertising is subtle. It's kind of like you don't notice it, but you do notice it. You notice it like subconsciously because they have advertising literally everywhere.
Yep.
Everywhere.
Yeah, and Coca-Cola is one of those companies that does pretty much strictly what's called brand advertising or brand marketing, where it's just brand awareness. They can't get you to buy a Coke straight from a YouTube ad, for example. They can't get a direct click and a buy. They just have to put that brand in front of your face as much as possible so that when you're thinking about getting a drink at some point throughout the week, that you think of Coca-Cola. And those types of ads are the first that get cut when businesses need to cut costs because there's no direct relationship between the effectiveness of that marketing, right? If you have a different ad where, what's an example of like a direct,
like one of the,
like one of
those YouTube courses. One of those YouTube courses where it's just like, hey, click the link below and buy my course.
Yeah. So with that, or like, so a retail business, for example, that's showing you a clothing ad or something from a website you've been to, they can track you. They track if you click the ad and then you bought and how many ads they had to serve you and
conversion rates.
They can check the exact conversion and ROI of those ads, whereas brand marketing doesn't have that same kind of effect. They don't know how many ads they served you before you bought a Coke, if you ever bought one. So they cut that first, and that's what we saw last year. Big slash in YouTube revenue it wasn't terrible, but it was a substantial dip definitely last year during the pandemic, and it's interesting to see that within a business like Coke, which I'm sure spends many billions of dollars on brand advertising throughout the year.
Absolutely, yeah. But interestingly, they're back, and I don't think like what you're saying. I don't think you can draw too much of a conclusion as to the advertising spend versus the revenue, because if you looked at it, you'd be like, oh, okay, so Q2 last year, they cut their advertising in half and, they cut their revenue in half. I don't think it's like what you're saying, that this advertising doesn't lead to direct sales, but it's certainly an important part of the ongoing brand, which is Coca-Cola, is their advertising. So, and it also shows that, clearly management feels like they're in a more comfortable position to continue to spend on advertising. The only other thing I wanted to bring up is just a little snippet from this article also in relation to inflation. They said, like most food and beverage companies, Coke is seeing higher commodity prices. However, Murphy said that the company feels good about the rest of the year. The company plans to raise prices and use productivity levers to manage the volatility in the second half of 2021. So not too much to say here, but interestingly, of course, Coke is going to be feeling the effects of inflation. But they're another business, as said by their CFO, that are just going to raise their prices. And this is what we always talk about with brand moats. Companies with big fat brand moats where people buy their product because of that brand, they can do that. They can just bump up the price a little bit and really suffer pretty much no negative consequences. Obviously, you can't push it too far, but I mean, they can raise prices a little bit, really with no consequences. Yeah,
Coke's one of those businesses that's just has huge pricing power, which is extremely rare in the beverage industry as well. Most companies can't raise their prices in the beverage industry without seeing a substantial drop in demand for those products. So it's one of those it's one of those industries that is very demand elastic. So if prices change, people react to price changes. People are willing to, in most cases, excluding big brands like Coca-Cola, people are willing to go for the cheapest alternative drink that they can get. And very few businesses like Coca-Cola have pricing power where people are unlikely to switch to a competing product and off-brand Coke, even if prices go up. So very impressive that they're able to do that. And those businesses will be able to raise prices as costs go up and kind of protect their margins, and their sales probably will still go up with that, whereas other businesses will just experience the increased cost and they won't be able to raise their prices to compete, and they will become less profitable. So I think we're going to see more of that over the next couple of years.
Yeah. No, absolutely. Alrighty. Well, that is pretty much all I had to say about Coke. We've surprisingly, we thought we were going to run a little short on time today, but we've got a lot to talk about. So let's leave Coke there because they're really the main points. I want to hear about Chipotle.
Yeah.
Tell me about
Chipotle.
Chipotle.
This is the most important thing of the quarter to talk about Chipotle.
Of the economy.
Of the economy, yeah. This is front page stuff. So Chipotle, of course, reported, so their revenue came in at $1.9 billion for the quarter, which was up 39% year over year. So they're still seeing these massive comparisons to last year when they were partially shut down. Although last year they still did extremely well. They were one of the few businesses that still grew, I think, in the restaurant industry, which was really impressive. But that revenue growth was driven by comparable sales growth. So the growth of revenue at existing restaurants, that was up 31.2%, which is just off the charts good. They also benefited from opening new restaurants. So they opened 56 new restaurants and they closed 5. So they had a net of 51, if my maths is correct there. And that brings their total to 2,853 stores, Chipotle restaurants, I should say, throughout the US. So they're a massive chain now. They're really getting up there. Not many restaurant chains have a few thousand stores. So very impressive.
And just remind me quickly, because I think you keep a closer eye on Chipotle than I do. Last year, we were surprised because they did keep growing because everywhere else was kind of suffering, right? Was that because they were doing like takeaway or home delivery or something more so than in-store sales? Is that correct?
Exactly.
I can't quite remember.
So exactly. I think Chipotle benefited from two things. One was they already had a really good infrastructure for doing delivery sales. They have their Chipotlanes, which people can now order online and just come through, like McDonald's, where you can do contactless pickup. So they benefited from that, as well as the fact that they clearly have a very, very strong brand appeal with customers, and that customers, even though the restaurants were closed, or a lot of them were closed to physically go into, people still wanted to get Chipotle. And that just showed in their numbers. But even this quarter, a year later, digital sales grew 10.5% and still accounts for 48.5% of total sales. So A lot of people are still ordering, like air quote online. But what that really means is, people are ordering online, and then most of them are picking up their orders in store, going through the Chipotle, going through the drive-through. They're basically setting up their business in many ways like McDonald's has done, where they get a lot of fast deliveries coming through, and they can, even in periods where people don't want to go and sit in the stores or they're not allowed to, they can. Here's a quote from management that I really liked. Guests are increasingly appreciating the value and convenience offered by this channel, as well as the added convenience of more Chipotlanes. So
I told you we were onto something.
I'm pretty sure we coined the term Chipotlane, right? We said that.
I think so.
Yeah, we said it.
Still waiting for those royalties, though.
Yeah.
They're really building up now.
Yeah, I sent them a few emails. Nothing kind of got through.
Didn't get anything back.
Yeah, they put in 45 new Chipotlanes, so they're accelerating their expansion of the Chipotlane.
Oh dear! I just wondering, how long are we going to keep this joke running for?
I'm never going to stop this joke.
I'm just like, in 10 years, are we going to do the, Q2 of 2031 and Chipotle's added another 5 Chipotlanes? It is funny though. Good old Chipotle. I just love that name so much.
It's so bad.
Name is fantastic.
It's bad. It's terrible.
No, it's fantastic. What are you talking
Just
about?
call it a drive-through. You don't have to reinvent the wheel. Like, I wonder how long they spent, how much money in like labor hours they spent coming up with this name. Like, they had a board meeting. Oh, should we call it Chipotlane or the Chip drive-through? I don't even. Like, a waste of time. Yeah. Call it drive-through, all right? The name is, it's been made by McDonald's, all right? Just leave it.
I don't know. Maybe McDonald's has some sort of
trademark or something.
Sort of rights to the word drive-through.
They might. I wouldn't be surprised if they did.
No, I wouldn't be surprised either. But probably not. I mean, surely there's got to be some stuff that you can't. I don't know. You can't claim. Like, surely, like a drive-through lane. You couldn't put like a patent on that.
That's yeah. You wouldn't think so, but.
Yeah.
Anyway, so restaurant level margins hit 24.5%, which is the highest level since 2015. So their restaurants are performing extremely well on a cost basis as well. And management said that this was driven by menu price increases. So they've been increasing prices, and also lower beef prices. So beef actually has been coming down in price. So that's kind of interesting, interesting kind of flavor to add to this inflation story that we're talking about. We've had a lot of different commodities going up in price substantially. Beef is one that is kind of down a little bit this year. And then labor and occupancy costs were also down as a percentage of revenue. So in terms of all of their costs, they were able to get them down and become more efficient. And as a result, their profit margins at the restaurant level have improved. So overall, what that meant was net income came in at $188 million, which was up from $8.2 million last year. So even though they did quite well last year, on a margin basis, they were terrible last year. They had massive cost increases. So they're back to back to the best margins they've seen since 2015, which is obviously really good. One thing I saw when I was looking, so the stock was up 12% today on the news, and the first article that popped up on Google was titled "Chipotle stock jumps into new buy zone," and I was a little bit confused, so I wanted to read this article. In this article, somehow this author makes the argument that because the stock price has increased 11%, it's now a buy. So I just thought I'd chuck this in. It's good to know that we've still got some highly reputable analysts out there who believe that a stock is more attractive at a higher price. Good to know that that's still making the number one article on Google. Good to know that the average investor is in good hands. If they Google search things, they'll find accurate information about how to invest in businesses. But
absolutely, that really just tells you more about how investors typically act. What articles they click on, where their mindset's at. Oh, it might be a buy. Look, it's been going up, therefore I might buy it.
It's almost like the guy wrote the article assuming that Chipotle stock price would be down, and then it went up, and he was just like, screw it, I'm just gonna it's like he was thinking, Chipotle stock goes down and is now a buy, but then the stock went up, so he was like, Chipotle stock went up, it's now a buy. Yeah.
It does feel like that, doesn't it? Isn't that so funny? Gosh.
Ridiculous.
Oh dear. Yeah, I like what you say. People are in good hands, aren't they?
Oh yeah.
That is crazy. That is crazy. Anyway. Oh dear.
Should we do some Q&A? I think we've got a
yeah, I think I'll just save this stimulus check story for next week because we are running short on time. We do want to respect people's time. We'd like to keep the show at about an hour. Feel like that's a happy kind of medium. Don't want it to drag out for too long. I feel like Joe Rogan is the only person that can have like a 3-hour podcast and still be interesting at the end as he was at the start. But I feel like for us, talking about investing, an hour is probably good. So yeah, let's get started. Where should we start with Q&A?
Yeah. Here's an interesting one. I'll read this one to you. Hey guys, my question is just, are you guys going to do another episode with Jason Hughes anytime soon? As an economics student, myself, I found the way he describes things very interesting, a lot better than my professors. Thanks guys. Love the podcast.
There you go. I'll have to pass that on to Jason. Yeah, Jason he's just a big brain, isn't he?
Oh yeah.
He is a big brain, that guy.
He's very smart.
I love Jason. We'll have to get him back on at some stage. Yeah. I definitely like talking to him. He knows so much more about finance and economics than I do. I mean, he has studied it. I have not studied it at university. But yeah, I learn so much from him. I always, like, if I'm stuck, I just ask him I just like, hey, Jason, can you tell me how? He's like, yeah, sure.
Yeah. His understanding, particularly of macroeconomics, how the big ideas function and like how the Fed works and that sort of thing is, it's unrivaled.
Remarkable.
So we'll have to get him back on for sure.
Yeah. Yeah, and he's young too. He's young. He's certainly worked hard on increasing his knowledge, and it's really paying off for him because he is a young guy and he's very, very smart. So yeah, we'll have to get him back on. All right, let's. What question should I ask? I'll ask this one here. Hi guys, what is your general take on Baba? So Alibaba. There is clear momentum among key investors with this business. And I think he means like the super investors. There's people buying in. Is the idea of cloning super investors justified?
Yeah, that's an interesting question. Yeah, Alibaba has really been the face of cloning at the moment with who's invested in Charlie Munger, Monish Pabrai followed Charlie Munger into it. So Monish really cloned Charlie, I think, on that one. I'm sure there's a number of other investors. And as a result, a lot of people have kind of run into Alibaba. I mean, my general take on Alibaba is I don't understand that business. It's crazy. It's very complicated. I think they have a lot of bits to it. 50 to 100 or maybe even more subsidiaries, so little different businesses that make up their overall business. Plus, they own a 30% stake, I believe, in Ant Group, which is a private business. So you have to put a value on that as well, which is a private business. Don't have too much data around it, and add that value to Alibaba. So very confusing for me. Not one that I would be investing in. But in terms of cloning, I'm not against the idea of cloning. I think that you can get ideas from good investors. And I think you can look at what like Warren Buffett, for example, has invested in and what was his logic back in the day in certain investments. I think there's a lot of value there. But ultimately, if you invest in something as an individual business, Alibaba, for example, I think you also need to understand it. And you need to be careful that you're not letting the fact that a super investor has invested in it influence your analysis too much. You don't want to fall into the path of thinking, I won't, I'm interested in Alibaba. I'm not going to clone Charlie Munger. I'm just going to do my own research. But then really the whole time you're kind of just confirming the bias that, well, if Charlie Munger invested in it, then it must be okay. So yeah, I think you have to understand the business. I think you can get ideas, but you still want to try and do your own independent analysis and make sure that it makes sense for you.
Yeah. Yeah, absolutely. My take on Alibaba is, I think the reason why a lot of people are getting interested in it is because people have seen the success of Amazon and then they turn to Alibaba, which is a similar business but in China, and they just see it is just so much cheaper than Amazon. Like it's no doubt. I had a look at their financials. Very, very solid business. Cash flow machine, absolute cash flow machine. And it's when I did the discounted cash flow analysis, didn't seem to be very expensive at all. In fact, I would argue that it's probably cheap right now. Of course, just don't take my word on that. Obviously, you need to do your own research. But I think that's really what it comes down to, is that value investors are looking at the growth potential of Alibaba, the moat that Alibaba has over in China and how they're expanding it. Growth potential moat, they're looking at the cash flow, how much cash gushes out, and then they're comparing that to the valuation. And I think to a lot of people, it seems to be at the moment that they are really interested in that proposition, because pretty much everything else that has kind of that amount of cash flow is considerably more expensive, really, really, really a lot more expensive. But everything that you said about actually cloning, I agree with. Like, there's no doubt cloning is a legit strategy. Cloning is not simply the act of copying. It's not Warren Buffett bought this, I'm buying this. Mohnish Pabrai bought Alibaba, I'm buying Alibaba. It is more, the way I think about cloning is it's taking the hints from the big investors as to where you might want to research further. It's like getting the best investors in the world to give you a guiding light. Hey Brandon, hey Hamish, you might want to read about Alibaba a little bit more. If Warren Buffett, when he bought Apple, hey Brandon, hey Hamish, you might want to do your own research on Apple and come to your own conclusions. It's just kind of like a nudge in the right direction, I guess.
Yeah.
And even if you don't want to buy it, it's good to reverse engineer why you think they bought it. I mean, even if, say, Alibaba's outside your circle of competence, Hamish, then it's still a great exercise if you want to try and reverse engineer why you believe that Mohnish Pabrai and Charlie Munger might have bought Alibaba, so that you can then take those principles and apply them to something else.
Yeah, exactly right. Because the overarching principles, the approach to analysis is going to they're probably approaching analysis in a very similar way to Alibaba, to other businesses. So yeah, I think you're right that there is certainly a lot to learn from looking at investments that big investors make. But I think we'll leave the podcast there for today. Thanks everyone for tuning in as always. And if you want to ask a question for next week's episode, or you have a news topic that you want us to cover that you find throughout the week, then feel free to head over to the YouTube version of the podcast at youtube.com/The Young Investors Podcast. Click on the latest episode and just leave your questions as comments in the comments section. Thanks, Sharesight, for sponsoring. As always, head over to sharesight.com/young investors. That's site spelled SIGHT, sharesight.com/young investors, and get 4 months off a yearly subscription if you're interested. Thanks, Brandon, for joining me as always.
All good. Good fun.
Yeah, absolutely. And we'll be back next week to give you the investing news and stuff.
Yeah.
That's
give you the investing news and stuff. A lot of earnings next week, I'm sure. We'll be talking a lot about earnings.
We'll be there. We'll be there. Probably.
We'll be there. Are you falling asleep over there, Hamish? All right, I'm wrapping this thing up. Thanks everybody for listening. We'll talk to you guys next week.
See you guys.